Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of how to borrow stocks and potential short squeeze setups. Today, we're putting a specific microcap company under the microscope, NCRA Inc., trading under the ticker NCRA. This stock has hit our screener with some truly eye-popping cost to borrow numbers that demand our attention. We're going to break down exactly why NCRA is on our radar, what those numbers mean, and what you should be watching for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show NCRA logo/ticker. Let's start with a quick overview of NCRA Inc., or NCRA. This company operates in the consumer defensive/packaged food sector, but their core business is quite unique. NCRA Inc. is an acquisition-focused company that provides land-based recirculating aquaculture system services to aquaculture projects. They are involved in fish farming, selling aquatic products, and producing food products, designing and building the necessary equipment. With a market cap of just $2.06 million, NCRA is firmly in microcap territory, known for its high volatility. Looking at the recent price action, NCRA has been on a wild ride. Today, it's down -10.38%, but it's still up an astonishing plus 1523.76% over the last 5 days, and plus 632.14% in the last 30 days. Show price chart. What is cost to borrow and why it matters? Before we get further into NCRA specifics, let's clarify a key term: cost to borrow, or CTB. When you short a stock, you're borrowing shares from a broker to sell them, hoping to buy them back later at a low price. The cost to borrow is the annualized fee you pay to keep those borrowed shares. It's essentially an interest rate. If a stock has a high CTB, it means there's either very high demand from short sellers or a very limited supply of shares available to borrow, or often both. These fees can easily exceed 100% annually, meaning short sellers could pay more than the stock's entire value in borrow fees over a year, forcing them to constantly reassess their positions. Why this stock is hard to borrow right now. Now let's apply that to NCRA. The numbers here are truly extraordinary. NCRA currently has an annualized cost to borrow fee of an incredible 1093.1%. Highlight CTB number to put that in perspective. Anything over 20-30% is considered high. This fee has also seen massive momentum, jumping an additional plus 976 percentage points over just the last 5 trading days. This rapid increase signals extreme pressure in the borrow market. How many shares are currently available to borrow? A near 8,000 shares. That is an incredibly tight supply for a stock that has seen significant trading volume recently. Our internal composite squeeze score, which combines factors like CTB level, CTB momentum, shrinking borrow supply, and price action, currently sits at a very high 71.5 for NCRA. These metrics collectively tell us that NCRA is not just hard to borrow, it's extremely hard to borrow right now. Squeeze mechanics explained. So, what does it mean when a stock is hard to borrow? It means short sellers are finding it very difficult and expensive to open new short positions, and existing short sellers are facing escalating daily costs. This can lead to what's known as a short squeeze. A short squeeze occurs when a stock's price begins to rise, putting short sellers in a losing position. Faced with rising losses and sky-high borrow fees, they may be forced to buy back shares to close their short positions. This buying action, in turn, drives the price even higher, triggering more short sellers to cover, creating a rapid upward spiral. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock's price will eventually fall, and they are willing to pay a premium to maintain their short positions. Dilution risk check. One critical factor that can negate even the strongest short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can absorb buying pressure, drive the price down, and effectively provide an exit for short sellers by making shares easier to borrow. For NCRA, our check shows no recent dilutive SEC filings such as -1s, -3s, or 424 BS found in the last 90 days. This means, for now, there isn't an obvious near-term risk of the company flooding the market with new shares, which is a positive sign for any potential squeeze scenario. Recent reverse split watch. Another important recent development for NCRA is its reverse stock split. Just 2 days ago, on July 7, 2026, NCRA executed a 1-4-30 reverse split. What does this mean? A reverse split reduces the total number of outstanding shares and proportionately increases the share price. For instance, if you own 30 shares at $1 each, after a 1-4-30 split, you'd own 1 share worth $30. While reverse splits are often done by struggling companies to boost their share price above minimum exchange requirements, it's a historical pattern observed in many microcap stocks that they can see renewed volatility or even a price pop within about a month after a reverse split. This is a tendency seen in some names, not a guarantee, but it's certainly something to keep in mind for NCRA given its current high CTB. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with NCRA? Show chart with CTB and shares available. First, keep a close eye on the cost to borrow fee and the number of shares available to borrow. Any further increases in CTB or decreases in borrowable shares could intensify the squeeze potential. Second, volume is crucial. Today's volume for NCRA was 540,800 shares. This is a fraction of its 30-day average volume of over 19.5 million shares, indicating significantly lower activity today compared to recent spikes. High volume is often needed to sustain price momentum in a squeeze. Third, watch the price action itself. Look for strong upward moves on increasing volume, and watch for short sellers potentially covering their positions. Remember that NCRA operates in the consumer defensive/packaged food sector, so broader market trends for this sector could also play a role. In summary, NCRA Inc. NCRA is exhibiting some truly extreme hard-to-borrow metrics right now, with a 1093.1% CTB and only 8,000 shares available. Coupled with its recent reverse split and lack of immediate dilution risk, it's definitely a stock that fits our educational focus on short squeeze mechanics. However, always remember the risks involved with highly volatile microcap stocks. This is an educational deep dive into fascinating market dynamics, not a recommendation. If you found this breakdown of NCRA helpful, please hit that like button, subscribe for more in-depth analysis of hard-to-borrow stocks, and let us know in the comments if there are any other tickers you'd like us to investigate. Thanks for watching, and happy learning!